My presentation is an overview of the various insurance premium taxes and surcharges that ultimately make up the insurance premium that our citizens pay. There are four primary taxes that I'll touch on, and they certainly support some significant amounts of dollars for our general revenue, the municipal pensions, volunteer fire departments, the fire marshal's office, and the teacher's retirement system. Also touch on where West Virginia's premium tax percentage compares to that of other states, and finish with the workers' compensation surcharge. So the first significant tax and the broadest tax is the 3% premium tax, and you can find that in Chapter 33.3.14. That's the first 2%, and then in Chapter 33.3.14a, there's another 1% added. These funds go into what's called the insurance tax fund, which is ultimately transferred to the general revenue fund. The tax is assessed on all lines of insurance, unless an insurance company may have a special license by statute where they be exempted from taxes. So that means that your life, your health, your property and casualty, which includes your auto and your homeowners and everything else that you think of, is taxed at a 3% rate to start off with. The code also requires that all insurers that are licensed here to pay a minimum amount of $200 on an annual basis, regardless of writings. That tax brings in $111 million annually on average for the state, and like I said, that goes to the general revenue. All right, in addition to that tax, there is a 1% additional tax found in West Virginia Code 33.3.14d. This is not on all lines of insurance. This is just on your property and casualty, your homeowners and auto, and other commercial lines. Those funds go into the municipal pensions and protection fund, and then are allocated, as you can see there on the chart, 65% to municipal police and fire pensions, 25% to volunteer fire departments, and 10% to the teacher's retirement system. Brings in about annually $22.7 million. So far on property and casualty, you have a 3% and a 1% additional tax. Then in addition, on your property and casualty policy, you have a 0.55% surcharge. These funds go into the fire protection fund, which helps support our volunteer fire departments. They are distributed quarterly by the treasurer in equal shares to the, I'll say 420, there may be a little bit more than that, VFDs to help run their operations. A surcharge is a little bit different than a tax. It's calculated the same way, but technically the obligation is on the policyholder, not the insurer. The insurance company then collects those funds on behalf of the state and remits those as part of their normal tax filings. The estimated annual revenue for the surcharge is $12.5 million. The premium tax and the additional tax haven't had a whole lot of legislative changes. However, the surcharge did decrease in 2005. When it was originally enacted in 1992, the surcharge was 1%, with 50% of that going to volunteer fire departments and 50% going to the teacher's retirement system. In 2005, this body lowered the surcharge from 1 to 0.55, its current rate, took the teacher's retirement out of it, and then gave a slight bump to the volunteer fire departments. Still staying with your property and casualty insurance line, we got another tax that adds on to that. That's West Virginia Code 29.3.22. That is your fire marshal's fees fund, special revenue account that helps, it's under the purview of the fire marshal. This tax is on only the amount of premium that is for the hazard of fire, and so the way that it's addressed is in the tax forms. On the fire line, it's taxed at 100%, auto at 5%, and homeowners at 60%. And that brings in, for the fire marshal's office, about $1.9 million each year. Those are the P&C taxes, but there are other taxes out there I kind of want to touch on too to make sure you get the full picture. There is a 1% annuity tax that's in West Virginia Code 33315. Those funds also go to the general revenue, and that money is collected on the gross amount of annuity considerations collected and received, brings in about $4 million. West Virginia is a little bit unique in that only 7 other states do tax annuities, which are often considered a savings vehicle. And most of those states then would have an exemption for a qualified retirement plan, which West Virginia does not. So we tax all annuity considerations, and you can see the 7 states listed there. Moving on to surplus lines. So everybody knows that there are certain risks out there that are of such a low volume and such a high risk that the voluntary market is unwilling or unable to write. So the way that is met is by the insurance agent placing that coverage with a surplus lines or an excess lines carrier. For your, everybody's familiar with the med-mal instances there, but you also have those in other lines, you know, your fireworks sales, your hazardous waste storage, etc. The tax on surplus lines is 4.55%, and the way that is broken down is 88% of the 4.55 is treated just like the additional tax we spoke about earlier. 65% of those revenues going to municipal police, 25 VFD, 10 volunteer fire. Then 12% allocated the same as the 0.55 surcharge, it's 100% to the VFD. So that breaks that revenue out at 4.5 million. 88% equals 4 million, and 12% is 5.5. So you take all those and you come to the summary, and here's how everything shakes out. On an annual basis, general revenue from the premium taxes gets about $115 million. Municipal pensions, 17.3. Volunteer fire departments, 19.7. State fire marshal, 1.9. And teachers retirement, 2.7 million. For a total of 156.6 million, making it one of the larger tax bases for our state budget. Wanted to kind of provide a comparison of how West Virginia compares with the other states in the nation. So on the left column here, you'll see the property and casualty. You get the 4% tax plus the 0.55 surcharge, takes you to 4.5%. That makes West Virginia the highest of all the states. Average state P&C premium tax is 2.14. Most common is 2%. And there's some surrounding states. Kentucky's at 2, Ohio's at 1.4, and Virginia at 2.25. Same on the fire premium, obviously. The additional fire marshal gets you to 5.05. We are second highest. Montana has a fire fee also. Takes them above us, but again, most common there is 2%. So what does that mean to our domiciled insurers, and how does the state of West Virginia operate? We are a retaliatory tax state, as is most states in the nation, which tries to provide a level playing field for insurers. And essentially what that says, if you're going to tax my domestic insurer at a rate higher than what my state tax is, then anybody that writes business from your state, I'm going to tax them the same rate. So in our example here, you'll say state X is at 2%. West Virginia's at 4.5 for the property and casualty. Any domiciled state or any domiciled insurer here in West Virginia writing in state X, they're going to have to pay another 2.5% in that state where they're competing. So as far as a revenue generator for us, retaliatory taxes don't generate much money here because we also have the same scheme because certainly we are one of the highest tax states when it comes to premium. There is a section in the code, 33.314B, allows insurers to take a credit or mitigate their premium tax exposure. However, it is very limited. You have to have at least 25% of your admitted assets in West Virginia securities. You have to employ less than 20 FTEs, have less than $10 million in premium, and then also provide at a minimum 50% of your premiums that to be derived from insurance provided to underserved areas in West Virginia. No insurers sought this credit in 2014. So I'll move on to workers' compensation surcharges. They're just a little bit unique in that the workers' compensation chapters 23 with the privatization, they are not subject to any of the premium taxes that were mentioned earlier. They have their own tax section in Chapter 23. In lieu of all those taxes, what is assessed is a surcharge for employers, and there's a 9% surcharge that is on every employer's policy, and that is dedicated to pay down the old fund deficit when the state ran and provided workers' compensation coverage. And in addition, there's a 5% regulatory surcharge also on the employer's workers' compensation policy, and that funds our office's responsibilities that were moved over for the Workers' Compensation Commission. Primarily, you can think of that as the appellate process, which is the Office of Judges and Board of Review and the folks that work there. And I'll just wrap up and answer any questions. I did want to kind of touch on all the, this is just the pledge revenues that are going to the paying down of the deficit position of the old fund. And you can see the policyholder surcharge is $34 million. In addition, those that are self-insured for workers' compensation pay $9 million. $95.4 million of your personal income taxes on an annual basis goes to pay this old fund liability. Severance taxes certainly fluctuate with the market. I've got $108 million. Mr. Mucco may have a better number. And lottery at 11. So the 95.4, the 11, and the 9 remain constant every year. The 34 million is based upon workers' compensation premiums. And as you know, we often, I think we've had 10 or 11 straight years, we've lowered those, so that number continues to drop. And then the 108 million, the severance, is based on oil, gas, and timber production. Gives you $257 million of tax revenue every year to pay down the old fund deficit. And that's the end of my presentation, Mr. Chairman. I'll be happy to answer questions.